This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Saretsky here. Welcome back to the show. We got lots to chat on this week. We got an update from the Bank of Canada. We got some activity, of course, which is going to impact variable rate mortgages. We got some update on our inflation views, monetary money supply, and of course, an update on what this means for the housing market moving forward. So, last week we put this episode together. We said, okay, listen, here's what the prelude to the Bank of Canada. It basically came in right on the screws as expected. The Bank of Canada raising rates 25 basis points and signaling a pause. Of course, I think it was a pretty dovish statement from Tiff Macklem at the BOC. Canada being the first central bank in the G7 to come out and officially say, we're going to pause and assess from here. So, the fact of the matter is that we've taken rates from 0.25% to now 4.5% in less than a year. So, 425 basis point move in less than 12 months. The fastest rate hiking cycle in modern history, and particularly when you account for the levels of debt in today's society, this is the fastest and tightest rate hiking cycle, even more so than the 1980s. Again, when you actually adjust for the levels of debt, particularly private sector debt. So, I want to clip in Tiff's comments right here because I think we should hear it from the man himself. Let's clip that in right now.
Yes, as you said, Mark, we raised our policy rate today, and we've signaled that it's time to pause and provide some time to assess whether we've raised interest rates enough to bring inflation back to target. So, what does that mean? Well, what it means is that if economic developments, and in particular, if inflation comes down in line with our forecast, that'll confirm that we've likely done enough. If, on the other hand, we start to see an accumulation of evidence that inflation is not coming down in line with our forecast, we're prepared to raise interest rates further. I want to stress that this isn't going to key off one piece of data or one release. We're looking for an accumulation of evidence, and there, as you know, we follow a whole range of indicators. But clearly, some of the key things we're going to be looking for is we're already seeing the effects of higher interest rates slowing demand in interest-sensitive sectors. We do expect that to gradually feed through more to services prices, which are going to take longer to come down. That's something we're going to be watching. We're going to be looking to see that inflation expectations come down with inflation. And importantly, we're going to be looking to see that inflation is indeed coming down in line with our forecast.
So again, basically Tiff, to sort of summarize, says, listen, we're going to hold rates here so long as this sort of aligns with our view on how the economy and inflation is going to progress from here. Of course, you can see his detailed comments, charts, data, all that stuff that the Bank of Canada is actually looking at in their monetary policy report. But I can give you basically a quick Cole's notes if you don't want to go and read a 25-page report. Basically, their Bank of Canada is essentially projecting a soft landing. That's what they're calling for based on their monetary policy report. So they're saying, listen, we're going to have the soft landing. GDP growth is going to slow. We might tiptoe into a very soft, subtle recession, and inflation is going to continue to roll down. And they've got inflation kind of hovering down, I believe, about sub 3% by the end of the year. So that's kind of what the Bank of Canada is projecting. Now, again, we're going to see how that all progresses, but assuming that's the case, that's what the Bank of Canada is saying, assuming it progresses here. Now, again, these are very difficult to predict given, to the geopolitics involved, the deglobalization narrative that's playing out, China reopening, what's going to happen in the war in Ukraine, and how is that going to impact commodity prices. So this is like extremely challenging market to try to predict, inflation 6 to 12 months out from here. But, if you use basically the data and information that we have available today, assuming not a lot changes, inflation should roll off relatively quickly. Of course, my good buddy here, Rich Diaz of Acorn Macro Consulting, we chatted about this on the Loonie Hour, is a great chart where they've basically modeled that inflation gets down sub 3% by September of this year. So again, we're going to wait and see. Information, data can change, and that's the whole point of the show, is to continue to evolve our views. I find it continue to be fascinated by the amount of people, in the YouTube comment section, Twitter replies, etc., that have a clear-cut idea of exactly where inflation is going to be 6 to 12 months from now. They know exactly that oil prices are going back to $150 a barrel, and that we've got hyperinflation on the way. So again, I'm not going to be naive to suggest that I have any clear path on that. I have a personal opinion, which is I think that inflation, as you guys know, I can think it continues to decelerate from here based on the simple information that we have readily available today. Of course, if you go back to basically every single central bank, in the last 20, 30, 40 years, central bank policy, every time the central banks have effectively paused, so that, you start your rate hiking cycle, you pause, 9 times out of 10, the next move is a cut. Okay, so the swaps market right now is calling for 2 rate cuts of basically 50 basis points. So 25, cumulative cut of 50 basis points by the end of this year, by the end of 2023. So that's what the markets are pricing. That's what they're expecting the Bank of Canada to do. Again, these are the markets. This is not my call. This is not the Bank of Canada's call. So we're going to wait and see. Markets have been, can be, wrong. This is what the swaps markets are currently pricing. So keep that in the back of your head as we move forward. Now, what's interesting to note is that, despite all this, you're seeing these narratives that are playing out in the real estate industry saying, oh my gosh, see, the pause is here, the rate cuts are coming, the housing market's back on its feet, things are going to rip roar from here, buy. And so I'm going to try to put out a sort of a balanced view here, because I think what's important is not to take things out of context. Right now we have an uptick in housing activity. We've come out of this. People have been sitting on the sidelines for the last 6 to 8 months, watching and waiting to see what's going to happen with interest rates. People are really nervous about the trajectory of the economy and waiting for house prices to fall, given that interest rates are up a lot. We now have a bit of pent-up demand that is being basically meeting very low levels of inventory. And so you're now starting to see a lot of stale inventory going into offers. We're seeing multiple offers popping back up. So everyone's got this excitement, right? Bank of Canada has come out and said, we're going to pause. Maybe, fixed rates, mortgages are now starting to come down. And maybe this is the end. And so one thing I'll caveat here is that we have to take this with extreme caution, because if the housing market actually regains a significant amount of traction, i.e., this is the bottom, activity starts to really ramp up, you get a lot more multiple offers happening, prices maybe stop going down, maybe even they start trickling up. This prompts the Bank of Canada to go, okay, a clear easing of financial conditions. The housing market can clearly take it. Maybe we continue our rate hiking cycle from here. Maybe we continue to raise rates, or maybe we even have an excuse to hold them here for longer. So, those that are sort of cheerleading, the housing market higher here based on a pause in rate hikes, I think should be extremely careful, because you gotta be careful what you wish for. This will actually could potentially ease financial conditions and actually add to inflationary pressures. So I think you have to be extremely cautious about the housing market here. Let's not forget that the reality is that we are stuck with very low inventory. Inventory will start to tick up as new listings increase in March and April. And the reality is that variable rate mortgages today are now hovering at about 6%. And the reality is that nearly 35% of all mortgages in Canada that are outstanding, 35% are essentially variable rate mortgages. Now, you've got two product types. You've got your floating variable rate, Scotiabank, every single time the Bank of Canada raises rates, your payment goes up. Then you've got these fixed payment variables, which of course are now being triggered, which means more interest going towards principal, not enough to cover even the interest alone, so payments are increasing. Well, according to the National Bank, over the past, 70% of mortgages that are fixed payment variables that have been originated over the past 3 years have hit their trigger rate. So basically, the basically 35%, more or less 35% of all mortgages outstanding are increasing their payments here. This is going to take, it is taking a chunk out of disposable income. And, you hear these anecdotal stories of, people cutting back some of their spending, maybe not going out to the restaurant as much. And so this just takes time to filter through the real economy. And this has always been my base case. So if you do get the magical soft landing like the Bank of Canada is hoping, gradual sort of easing in the housing market, gradual easing in inflation, rates stay here, and maybe we start to see some rate cuts towards the end of 23, maybe into 24. Of course, the Bank of Canada is projecting inflation to get back down to 2% in 2024. Now, the other alternative scenario is, again, you continue this feeds through the real economy, you get a more severe recession, and then you're probably talking more about disinflationary effects that can bring rates lower. So, a lot to sort of digest there. I think it's just important to get clarity on the central bank narrative right now that is playing out. I think there's a couple other things to really see. We've talked about the housing market slowing down, being interest rate sensitive. 81% of home builders in the U.S. are now reporting an easing in building costs. And so that, again, we're starting to see some of that coming off. So assuming commodity markets stay relatively where they are today, you should continue to expect some easing in building costs. And again, a continued slowdown in inflation. But these are things that are always very tricky to predict. So we have to be extremely cautious, I think, moving forward. And that's kind of the message that I would leave with you today. So as always, hope that helped. We'll see you next week.